You know, in South African law, there's a wall that absolutely cannot be breached. It's the one that separates the money you hold for your clients from the money you use to run your own firm. And getting this wrong, it's not just some small mistake. It's the kind of mistake that can literally end your career. So let's get into it.
Okay, let's put you in a situation. Imagine you're holding 100,000 Rand in your trust account for a client. It's for a property transfer. At the very same time, your landlord is on the phone. Your office rent is overdue. The money is right there. It's just sitting in the account. Can you just, borrow it? You'll pay it back as soon as your fees come through, right? Well, how you answer that question is the reason we're here.
The answer, of course, is a hard, absolute no. And look, this isn't just about being a bit sloppy with your bookkeeping. Under the Legal Practice Act, mixing these funds is a major offense. The best way to think about it is that every single law firm is managing money from two totally separate worlds. Let's step into that first one.
This is the world of trust money. The people who own this money, they're called your trust creditors. But don't let that word creditor fool you. A better way to think of yourself is as a safekeeper. You are just guarding their assets. That's it.
Now, this all boils down to one really powerful concept, your fiduciary duty. It's a fancy legal term, but what it really means is an unbreakable promise. It's like someone hands you the keys to their personal safe. You're the custodian, you're the guardian of what's inside. But you are never, ever the owner. That money is not yours. You can't use it, you can't borrow it, you can't even touch it for your own stuff. And believe me, the rules in this trust world are incredibly strict. For one, every single client, every trust creditor, has to have their own separate ledger. Think of it like a mini statement just for them. Second, if you add up the balances of all those individual ledgers, the total has to match your trust bank balance, perfectly, down to the last cent. But the biggest rule, the cardinal rule you can never, ever break, is the no debit rule.
Let's make this super simple. Say client A has exactly 10,000 Rand sitting in their trust ledger. You need to make a payment on their behalf, but oops, you make a mistake, and you pay out 11,000 Rand. That puts client A's account at negative 1,000. That's a trust deficit. Now think about it. Where did that extra 1,000 Rand come from? It had to come from somewhere, right? It came from the funds of your other clients. In the eyes of the law, you've just stolen money from other trust creditors.
All right, so that's world number one. Now let's jump over to the second world. This is the firm's own money. And this is the money you use to deal with your business creditors. These aren't people whose money you're holding. These are the service providers that you owe money to.
So who are we talking about here? Well, it's pretty much everyone who keeps your lights on. It's your landlord who's waiting for rent. It's the company that supplies your paper and pens. It's the provider of that expensive legal software you use every day. Basically, anyone the firm owes money to for its operations.
And the rule for this world, it's incredibly simple, but it is absolute. These creditors can only, and I really mean only, be paid from the firm's business bank account. The trust account is a total no-go zone.
And this is where you really see how serious this is. Dipping into that trust account to pay your office rent isn't just bending the rules, it's a huge ethical breach. And, as the source material makes clear, it is a criminal offense. The two worlds cannot mix, period. Okay, so we've met the two worlds, right? We have the trust world and the business world. Now, let's put them right next to each other because this is where the critical differences really become crystal clear.
When you strip everything else away, it comes down to this simple idea. On one side, you have your trust creditors. These are the people whose money you are simply holding. On the other side, you have your business creditors. These are the people your firm owes its own money to. It seems simple, but the legal consequences are massive. This table just lays it all out, plain and simple. But I want you to zero in on that insolvency row. This one is huge. If, for some reason, your law firm goes bankrupt, all of that trust money is completely safe. It's not part of the firm's assets, so no one can touch it. But your business creditors, the landlord, the stationery company, they're unsecured. They have to get in line with everyone else and hope for the best. That's a massive difference. So let's go to the worst case scenario. What happens if a lawyer just ignores all these rules, breaches that sacred fiduciary duty, and actually steals money from the trust account? Is the client just out of luck? No. And this is the ultimate dividing line between the two worlds. There's a safety net. It's called the Legal Practitioners Fidelity Fund. And its entire reason for existing is to protect the public from the theft of money they've entrusted to a lawyer. So here's the bottom line, and it couldn't be clearer. Only trust creditors can make a claim from this fund. If a lawyer steals the deposit you gave them for a house, the fund is there for you. But if that same lawyer doesn't pay their stationery bill, the stationery supplier has absolutely no claim against the fund. It's there to protect the public, not the firm's vendors.
Now, all of this sounds good in theory, right? But how is it actually enforced in the real world? How does anyone know if you're keeping these worlds separate? Well, this is where the auditors step in. They use a process called a trust reconciliation, and it's pretty straightforward. First, they list out the balance for every single trust creditor you have. Then, they add all of those up to get a grand total of what you owe to all of your clients. Step 3, they pull up your firm's actual trust bank statement. And then, here comes the moment of truth. The amount of money in that bank account must be equal to, or more than, the total amount you owe. If there is even 1 single cent missing, you have a trust deficit, and that is a massive red flag that gets reported immediately.
So after all of that, what is the one single thing you absolutely have to take away from this? It all comes down to one simple golden rule. Here it is. It's the easiest way to frame it in your mind. Trust creditors are the people you are looking after. Business creditors are the people you do business with. One relationship is about protection, the other is about commerce.
And that really gets to the heart of your obligation. To a trust creditor, you owe that sacred fiduciary duty we talked about, a duty of absolute unbreakable trust. To a business creditor, you owe a simple contractual debt. One is a matter of ethics, of law, of your right to practice. The other is just a matter of business. Getting this distinction right isn't just a good idea. It's fundamental to practicing law ethically and safely in South Africa. It protects your clients, it protects the public, and you know what? It protects you and your career. So the final question isn't for me, it's for you. You know the two worlds. Are yours kept apart?